In 2019, Sandeep Shetty, an Indian guy living in the UK, decided to pursue trading with a goal that many considered to be far-fetched, turning a small account of money into a life-changing fortune. With no previous financial background, Sandeep started his journey with a trading account of just $1,500, and he lost it all within a month. We've all been there. Undeterred, Sandeep saved up and tried again, funding his account with another $1,500, and he blew that one up as well. But then, instead of giving up, like so many new traders do, Sandeep decided to take a break from trading and focus on educating himself instead. And so he joined Timothy Sykes Trading Challenge, which is a well-known training program for day traders. He dedicated 2 whole months to studying before making another trade. He watched trading videos, he reviewed old charts, and studied specific setups like the morning panic dip, multi-day runners, and breakouts. And this period of focused learning was the turning point for him. In February 2020, Sandeep started trading again. This time he funded his account with $2,000, and his strategy was clear: stick to one setup and master it. That setup was the morning panic dip buy, a common pattern where a stock drops sharply in the morning and then rebounds shortly after. His edge came from identifying predictable emotional sell-offs and exploiting the bounce with strict risk management. And in March 2020, Sandeep managed to make over $7,000 in profits. By the end of that year, he'd hit $300,000. And by the end of the following year, he hit the million. So what exactly is the morning panic dip buy strategy that Sandeep Shetty used to become a millionaire? Well, it is a strategy that targets heavily sold off stocks during the first 30 minutes of the market open. The idea is to buy a stock after an intense emotional sell-off, a panic, and then ride the short-term bounce that often comes afterwards. It capitalizes on fear-based overreactions, particularly in low-float, momentum-driven stocks. So what's the psychology behind it? Well, if there's been some pre-market hype or a recent run-up that has caused a stock to gap up or spike over a few days, then what usually happens is early traders or overnight holders take their profits at the market open, which triggers a wave of selling, which often accelerates as stop losses get triggered, and then more short sellers pile in. Once the selling finally exhausts, the dip buyers, that's Sandeep, ignite a bounce, and the goal is to catch that bounce. So let's have a look at the criteria for a quality morning panic dip buying setup. We need to find a recent runner, so a stock that has recently spiked over the past 1 to 5 days. And the more overextended, the better. Those are ripe for panic. To do this, you can use the free real-time scanner on Webull. Look for the link in the description below. Go to Top Gainers, click on 5 days, and sort by volume. Find a stock that has at least 1 million in volume and a percentage change of over 20%. Next, we check that the stock has a small float. Now, the float is just the number of shares available for the public to trade, and we're looking for stocks that have a float of under 20 million, which basically means that there's a limited supply and therefore more volatility, bigger panics, and sharper bounces. To check the float, you can go to finance.yahoo.com, search for the stock, click on statistics, and look under share statistics for float and check that it's under 20 million. Next, check that the stock is trading well in the pre-market, which will tell you just how much interest there is in the stock before the market even opens. So if a stock is already trading millions of shares in the pre-market, then that means a lot of traders are watching it, and it's likely to be volatile and could drop fast after the open. So in Yahoo Finance, go back to the summary page of the stock and look at the percentage change in this pre-market section. If the percentage is green, then it means that the stock has been trading up in the pre-market, showing that this stock has interest and a panic sell could occur at the open. So now we found our stock, when do we actually enter the trade? Well, the ideal panic will occur within the first 30 minutes after the market open, which in the US is between 9:30 and 10 AM. Set your chart to the 1 minute time frame and look for a sharp drop of around 10 to 30% over a short time. Then wait to see the volume and momentum slowing with sideways price action, which could be indicating seller exhaustion. Now this is when the dip buyers start to enter. You don't want to catch the falling knife though, so you need to wait for confirmation of a bottom. Don't just guess where the bottom is. Let it form and show itself, and look back over multiple days and see where the support is. Sandeep stresses the importance of using level 2 to time entries. Now level 2 is a real-time display of the order book for a stock. It shows you all the buy and sell orders lined up not just the best price, but the full depth of the market. You can see who's buying, who's selling, how much and at what price. This gives you a behind the scenes look at real-time supply and demand, but it takes a lot of getting used to. So I suggest you go and look into this in more detail, as I don't have the time to do that in this video. But he also uses the VWAP, which is a bit like a simple moving average, except it is weighted by volume and not just an average of the price. So you're going to look to enter when the panic slows and you see a higher low, and where the price starts to reclaim key levels like reclaiming the VWAP or morning support level. But if you wait too long and the bounce has already taken off, then don't chase it, as you could get caught out. Now you really want to use a tight stop loss, because if it keeps falling with volume, you need to get out fast. So set it fairly tight or just below the low point of the panic. And look for a quick bounce of 5 to 20% and take your profits, perhaps into the first green candle near the VWAP or at pre-market support and resistance levels. This is not a hold all day strategy, it's a quick in and a quick out. Remember, if you miss the panic, then don't enter late on the bounce. You really only want to be entering at or around the bottom. And remember, this setup often fails, but small losses plus occasional big wins equals your edge. Now let's have a look at a few examples of some of Sandeep's actual trades. In this example, we can see the points at which he entered the trade with a long position and where he closed. Sandeep says that his thought process was that the stock had a massive increase in price in the pre-market with good volume, hence buying the dips near to the support and lows of the day, which is always a good risk-reward pattern. And he made roughly $5,500 buying the dip in the first half of the day and in the pre-market. And you can see that when the price pushed back through the VWAP, it soared straight up and he exited the trade at the top of that candle. In this example, again, we see well-timed entries after a big panic sell-off. Sandeep says that timing these entries comes from analysing support and resistance levels and a lot of chart reading experience. He also emphasises the importance of level 2 price action and says that this only comes by gaining lots of screen time. In this example, he bought this stock at a former support level. He has clearly identified a very key level of support in this area. He said there was consolidation at this point over the previous few days, and so he managed to enter pretty much right at the bottom, and he rode it all the way back up to the next resistance level where he exited the trade. In this example, Sandeep says that this is pretty much all he looks for, buying near former support levels. It's as simple as that. He identified a clear support level by looking back over multiple days and finding consolidation. He's then exited the trade back at this first level of resistance. Now let's have a look at a sheet from Sandeep's journal where he logs all his profits and losses over the month. And you can see the level of consistency that he is achieving. And yes, he has made a substantial loss here of over 20 grand, but that is to be expected and factored into the strategy. In fact, he even admits himself that he was surprised at only having a couple of red days in this month. But with many, many more green days than red, this leads to a winning edge. And just look at the profit he gained for the month, well over 230 grand. Now these figures are all after fees and commission, so that's what he actually gets to take home. Now let's not forget, at this point he is trading with a 200 to 300k account size, but he himself says that with this strategy, you can easily turn a 5k account into making 7k a month. And by slowly and steadily building your account up over time, this will lead to very large gains where you'll eventually be capable of making this kind of daily income yourself. Let's have a look at where the dip buying strategy can go wrong. This is from a different trader who was sure that this stock was a perfect dip buying setup, as the stock was a multi-day runner that was up by a lot and was sure to have a panic sell-off and a rebound at the market open. What we see from the chart is that it turns out he entered the trade too early, without waiting for signs of consolidation and a bottom to form. He then also added another position because he thought that the bounce was coming, but already holding on to a losing trade, he just ends up compounding the mistake. The stock never formed the expected bounce, and as it continued to drop, he lost more and more and ended up being forced to close the trade, losing over $350,000. So what do we learn from this? Well, we learn to be humble and remember that this setup is never guaranteed. We must also remember to wait for confirmation of a bottom, and also that if the stock continues to drop, we exit fast, keeping losses to a minimum, so that when we do win, our profits outweigh the losses. So some of the keys to Sandeep's success are a laser focus, just concentrating on one single high probability pattern. Strong risk management, never risking more than a small percentage of his account on a single trade. Journaling, reviewing every trade, win or lose, to identify what worked and what went wrong. And emotional control, avoiding revenge trading and FOMO. Importantly, Sandeep emphasized that the journey required thousands of hours of study, discipline and humility, especially in the face of early failure. Sandeep is still trading full-time, using the strategies that brought him his success, and he occasionally appears in some of Timothy Sykes' educational content, offering advice and insight to newer traders. And rather than seeking fame and showing off his wealth, Sandeep maintains a pretty low profile, focusing on consistency, protecting his capital and refining his edge in the market. This story isn't one of overnight success, far from it, but it is one of persistence. He went from blowing up 2 accounts to becoming a verified 7-figure trader by focusing on a single repeatable strategy, managing risk and committing to relentless self-education. We can all achieve the same success as Sandeep if we follow the same discipline. Now that's all I've got time for this week. If this episode has brought you entertainment and value, then please consider liking and subscribing to the channel if you haven't done so already. And as always, thanks for watching, and I'll catch you next time right here on MAFFMARKET.